The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So everybody has an opinion about most everything.
Yep.
One of the things that the Fed is looking for is a recession. And if you ask a random person, are we ready for a recession? Is it coming? And you probably get answers that are close to a flip of a coin. What do you look for? How do you know it's coming, and what do you do to prepare for it? Or should you? What if it's not coming? Well, do you
Those
have
are
an
really
opinion
good questions.
Yeah, so there's one thing that is fairly certain about recessions, that businesses hunker down when they're convinced a recession is headed their way.
It's not a big time of expansion. That's one of the reasons that causes the expansions, that businesses really curtail their spending, especially any discretionary spending they have. If it's not something that they have to spend, they're gonna put a hold on it because the potential for return gets reduced as purchasing numbers drop. And so during the recession or leading up to a recession, companies are gonna slow down what they're doing out there.
So the Fed's looking for high unemployment. Households aren't. People want to keep their jobs. High unemployment means I'm living on government dole, and it's not very much.
Not good. Yep.
Kind of like the old company store. I mean, I've got enough to get by here, but they don't pay enough to go out on your own and do something that becomes very prosperous. So we don't want unemployment to rise, but the Fed does.
Right.
Because that will slow consumer spending, which will slow demand, which will increase layoffs, which will take away purchasing power and buying pressure, and we get a slowing economy. And the GDP now at the Atlanta Fed is saying next year they expect 1% growth. You can't even pay for the federal interest on the deficit at a 1% growth rate. I mean, this is absolutely economic stupidity.
Well, the Fed doesn't get it. Yeah, like you said, Don, the Fed is really looking for that unemployment number to go up. They need that to cool off inflation. It's just not happening yet. It is not happening at all.
In fact, this last quarter, the unemployment rate is below 4% for 20 straight months.
How about that? Yeah.
The Fed's shaking their head, saying that's not what we're after. So
nope.
We added almost 2.5 million jobs in 2023. The year-over-year rates are good. Quarter-over-quarter rates are good. And they don't know why. They're doing everything they can to unwind those and put people out of work.
Right.
The Fed is not your friend. The Fed is not your friend because they are trying to cause economic pain. And then the administration wants to borrow more money. Borrowing more money is more than likely to cause higher interest rates as they search for investors.
There you go.
Now, this last week, we had a 2-day rally and a big rally on Friday.
Yep.
And we're scratching our heads saying, why on earth is that happening? It is so far out of normal trend trajectories. And it turns out that the Treasury Department, headed by Janet Yellen, made an announcement, or the Advisory Committee on Rates released their recommendation that instead of purchasing or issuing long-term bonds, they're going to stay in the short-term area.
Yeah. Yep.
And that brought relief on the assumption that longer-term interest rates are not going to have to rise. Of course, that's still based on the assumption that the Fed is a buyer, that Japan's a buyer, that the ECB is a buyer, and that China is a buyer of our bonds.
Correct.
Not so anymore. So the question is, who is going to buy them? In fact, our weekend webinar that we did, some of those questions were asked in the post-webinar survey, and the common assumption is the Fed is still a buyer of these bonds, and as the Treasury has to issue another almost 1.6 trillion between now and the end of March, that the Fed's going to be the buyer, and maybe Bank of Japan.
Yep. Yep.
There were a couple of people who said, I will, but not that much.
Right.
None of us have quite $1 trillion laying around to fund the
Don't
trade.
count on me for all that. Yeah, that's a big one. So,
but a strong economy looks like it's still in the game plan. And
it's
the leading economic indicator, we don't use leading assumptions. We don't make assumptions about the future for the market. But as far as the economy is concerned, there are leading economic indicators. And one of those major ones that we think is pretty reliable is how much money is being spent on advertising.
Right.
If advertising,
pull back advertising instantly. Yeah, they don't have to wait. They can pull back on advertising as they speak. And if they're worried about revenues being down, advertising is one of the places where they can say, well, if we're going into a recession, there's no need to advertise. We're not going to sell anything anyway. So we can save some money here. And that's one of the first places where their spending is going to evaporate. And it doesn't look like that's exactly happening yet.
Certainly not. And what is coming up not too far away is the Super Bowl
Sure.
58. And that almost always has record spending on advertising. And usually the last 30-second ad doesn't get sold until a day or two before game time.
They're very expensive. Yeah, you really have to find somebody who wants to pony up big time for advertising to get the 30 seconds or a minute at the Super Bowl. That's a lot of money.
Well, you're paying close to $7 million for half a minute. It's a big audience.
You have to trust your marketing firm at that point. You're going to drop $5-6 million on 30 seconds. It better be good. It better be good.
Well, this year is an exception. They've all been sold out, and Super Bowl is months away.
How about that?
If these big companies were preparing for a recession, selling Super Bowl ads should be a hard sell. And it's not. They didn't even cut prices. The prices are the same as last year. So the good news is they didn't raise prices.
Right.
But the bad news is apparently the economy is still strong enough. It's likely to lead to more inflationary pressures as we move into next year.
That is not one of the indicators the Fed's happy about, because the businesses who are in the economy, on the ground, watching what's going on, are still deciding that it's a really good idea to spend more money on advertising right now, meaning we think the sales are out there. We think the revenue is available. We just have to get our piece of it. And the best way? Marketing. They're going to go advertise. And some of the best, most watched commercials of the year are always the Super Bowl commercials. So companies are saying we still see revenue, we still see value in spending millions of dollars for a 30-second spot, and they're sold out early this year. So they're really banking on that coming back home to pay for themselves. So the Fed's got to be looking at that and saying, wow, these businesses do not see an economic slowdown yet. They've done, like you said, Don, they've done all they can. They've raised rates rapidly, and now they say they're going to keep them higher longer. But it's just not having the effect that they need yet. And maybe it's a lag, maybe it comes in later, but it's not happening yet. It's amazing.
So this time really is different.
Yes.
Things have changed in the market. Now COVID was different. Zero interest rate policy was different. Inflation is transitory, was not true.
Right.
So
wrong.
It too was different.
Oy.
So with all of this confusion, the normal reaction happens usually is, I think I'll just trust my gut. I mean, I can't make heads or tails out of all this other stuff. So I'm just going to trust my gut. So should you? There's an interesting question. Do you think your gut is a reliable indicator for a successful outcome in your own life or in investing?
A lot of people invest that way. How do I feel about this? Does it feel right? Does it feel good? Does it feel like the right time? And they'll make a decision based on that. And that doesn't always work out for the best.
So let's just take a theoretical question, and some of you may have heard this before, but let's just assume that you have a long lost uncle who has found you, and he said, well, I'm going to make you a deal here. Yeah, I've been pretty successful, and I don't have that much more time, so I'm going to give some money away, and I'll make a deal with you. I'll
Yep.
give you your choice, $1 million today, or a penny today, and double it every day for 30 days.
Right.
What do you want to do? Well, what's the most common gut reaction?
Gut reaction is give me the $1 million, bird in the hand. Let me have the million. A penny doubled. I don't care about doubling a penny. That's not my bag. Give me the $1 million. That's the most common answer.
And your gut is absolutely wrong.
Way wrong. Yeah.
A penny doubled every day for 30 days is $5 million.
Little off there. Yep.
The odds are you've heard this story before somewhere. If you've
Sure.
talked to a financial advisor somewhere in your lifetime, they may have used this to illustrate the issue of compounding interest. Well, compounding interest actually does work. It's also applied erroneously to stock market growth. We've covered that in a prior podcast.
You bet. You
But
bet.
compounding stock market returns isn't letting it sit still and assuming it's going to double periodically, because there are
Let alone every day. Yeah.
there are very difficult times in the stock market, sometimes as long as 20 years before
Yep.
you make a gain on a buy and hold strategy. But there's no real supportive research for trusting your gut. There's an economist, Daniel Kahneman. I think he got a Nobel Prize for his work on
He did.
investor behavior.
Right.
And it basically says that investor behavior is wrong most of the time. We react emotionally, and we're wrong. We need to look at data. We actually need a framework around which we follow rules to make our investment decisions, because the best investment decisions are made when the emotions are the most disconnected from reality. They're painful to make good decisions, and we need a solid rules-based framework, and then have the discipline to follow those rules.
That's it. We tell people that all the time. In fact, if you're gonna let your emotions creep into your investing at all, we tell people all the time, well, what you should do is the opposite of whatever you feel. If you feel like it's a good time to sell, you should probably buy. If you think it's a good time to buy, you should probably sell. Your feelings are probably going to be wrong more often than they're right. So we track data. We base our portfolio decisions on the data, not on the narrative, not on what the way we feel about it, not the way all the talking heads feel about what's going on right now. That's almost always going to lead you the wrong direction. You have to track the real numbers and make a decision based on those facts and not on how anyone feels about the market.
So it's not uncommon, particularly in our industry as financial advisors, to meet people who have hoarded their cash and savings for years and years because
Sure.
they felt bad about the market. They lost money in the last downturn, and by golly, this one won't last. This is a fake rally as it
Right.
continues to climb year after year after year. And
Fake rally, right?
it's
true.
It was not uncommon to go 3-4 years after the 08-09 bear market and find people still saying, I'm waiting for the market to pull back in order to put my money to work. Well, by the time it pulled back, it was 10 years later.
10 years later, and that's letting fear rule your investment decisions. And anytime you're letting emotions run your portfolio, either on the fear side or on the greed side, you're going to make mistakes.
Well, and fear and greed were real big players during COVID when people were staying home. The government dumped money in their checkbook, and then the Robin Hood phone app showed up, and we
Yep.
can we don't have to go to Vegas. We can
Yeah.
we can gamble right here on Robinhood, and the
This game's
majority
fun. Yeah.
they turned it into a game. That was creative programming, but it didn't help most of the people on Robinhood. Day
Right.
trading stocks or short-term trading were losers. They were trading
That's
their gut
painful.
reaction.
Yep.
It was well, there was no process. It was following the fun little icons, I guess, on Robinhood,
That's it.
and without rules, without reason, we had a whole generation of people who got excited, and they were just simply basically throwing darts in the form of money at their Robinhood program on their phone.
All you had
But
to do was be right one time and you thought you understood what was going on. You didn't. And over the course of the next year, they lost a lot of money.
when the stock market's falling, our gut often tells us it's all over. And when it's going up, our gut tells us to let it ride. But there's always a turning point at the bottom and a turning point at the top.
Yep.
And that requires data and discipline, a rules-based process. We use price and momentum to figure out where those turning points are. You need that yourself. If you want more information, you should review our webinars. Go to our website, iriradio.com is the shortcut. There's a lot of technical information there, but when it comes to people's reaction in the market, it's tracked as sentiment, investor sentiment. And when retail investor sentiment is negative, nobody wants to buy. The rules say that's where opportunity is. You're told
Pretty
to
good
buy.
time.
You know it's supposed to buy low and sell high, but
Yep.
the average investor has that backwards because their gut is driving the decision rather than taking some time to look at data. And it's the data that gives you a better edge at making a more consistent decision. It's not that all the decisions are good,
Correct.
but it increases the probability of having good decisions in your portfolio. You want more information from us? Look at the phone number, the email address that are popping up on the screen. Contact us. We'll be glad to talk with you. Subscribe to the podcast. But for us, I think that's probably a wrap.